Lutao is a management consultant at BCG, so he actually flew in today as well to join us. So all of them came to, so I appreciate that. It's nice to have an outside perspective. So when we got together, we wanted to put together a presentation about how great investments will be in this space and what you need to create, and then you'll get a lot of money from venture capitalists. We had our conversations and began our dialogue through email, and it became clear that one of the issues we were going to have to overcome is this issue that's developed through those last three presentations, which is in this environment for the telcos, what effect is that going to create on the innovators? So the people who are trying to, where's all the investment going? It's going into mobile payments and location-based services, obviously mobile advertising, that came up in the GSMA presentation. Some other areas, mobile security, of course. So the people that are trying to drive these new services are going to be confronted with the fact that the infrastructure is demanding so much investment. So I guess my first question, I want to make sure we have a chance before we bring in the audience questions, to make sure we all have a chance to talk a little bit about, in this environment, what is the effect on the entrepreneurial innovator? You spoke about Lutao, you spoke about Spotify is thrilled and Netflix is thrilled, but if I'm the next Netflix, and how do I get myself into the equation?
So I'll kick it off, and I'd love to hear my new friends over here on the right's view of this as well. I think that there's a couple things to be said about the way Google really thinks about the world. And one of the tenets behind it is, let me build a great product or service that people want, and let me give it away for free. And if I start there, I can drive a pretty large user base pretty quickly. Now, how is Netflix going to pay for the ability to use that network? How are any of the Spotify's, any of those players paying for it? It's the fact that they have a user base, and they've turned that user base into a monetized asset. And as soon as that happens, and as soon as you have stickiness behind it, you have the way to do it. And I think from a innovator perspective, you're going to end up having to go down that path. A lot of the venture funds in the past has been talking about how do you get customer acquisition, how do you make sure that you can build your base. Well, the fastest way to build a base is to give it away for free, which means that the way that your timing from the investment perspective, the way that you have to think about your cash flows at the early stage and the seed stage, and then the way that you have to think about transitioning from the giving it away for free to monetizing that base is going to be that much more important than it was in the past.
Hey, turn it on. Is that okay? So I'd say I have two answers to that. One is on the application side. If you think about WhatsApp selling for $17 billion, my guess is no one in here knew what it was. We all thought we could text, right? I mean, so I think barriers to entry on applications are incredibly low. Someone talked about the yoga, the elderly crowd on the yoga. Once my son figured out that my mom was on Facebook, his interest in Facebook has dropped precipitously, right? And so he's now Snapchatting. And so I think these applications occur, the barriers to entry on the application side are very, very low. I think where the barriers are very high is in the consolidation of the carriers. And the fact that if you're selling technology or services to the carriers, and I think about the tower space, I think about fiber space, it's become very difficult to get someone to try something new. In the US, you have 4 carriers. We used to have hundreds, and you used to be able to start with a small carrier to sort of get them to trial a technology. And today, there's 4, and they're always trying to merge, and so they're distracted. And so I think there are very high barriers on the selling technology into the carriers, and very low barriers in terms of applications that ride on the network.
Yeah, and I might be off topic, but we've done some work with people with tech, and it's so very hard to figure out how to value them. And to even figure out what their burn rate is. And typically, it just all sounds like what the founder of our firm calls the Chinese hot dog theory, where everybody can make $1 billion if you can sell a hot dog to every Chinese person in China. But there's barriers to entry there, I guess. And most of the entrepreneurs don't get that. So it is, and it's becoming more and more difficult because, as you said, the people that you can go to are becoming smaller and smaller, and getting their attention is becoming very, very difficult. So, sorry about that.
It's very true.
Yeah, answer the right question. So the question is, what are the metrics that are being measured for acquisitions in this space right now? I think the PE ratio point was to discuss the fact that these companies the telecom companies were underperforming generally to the S&P, and that there were some subsectors in the telecom industry that were outperforming the sector. But I think if you guys can talk less about the PE ratios and aspects of your slide, and more about what are the metrics being used to assess technologies and companies in this space, that'd be most helpful, I think.
Okay, yeah, so Back to the Future, this reminds me of like 2000. You remember if a company was pre-profit, you were valuing them on revenue, and then as soon as they turned a profit, it went down. I have a hard time seeing that and valuing it. I mean, everybody does DCF, discounted cash flow models, and trying to predict where the market will go for them. And as you probably know, most of the financial forecasts are always overly optimistic and always wrong. So that's not an art I'm very good at. I'll just admit it.
Yeah, I'd say we looked at some analyses. There was a little bit of a correction in the high growth tech stocks in kind of March and April. Prior to that, the R squared between growth rate and revenue multiple was almost 1. And so it was, the public markets were totally rewarding growth. The R squared is no longer 1, but it's still high, and so we are in an environment where growth rules. That will change.
So I would just say that from our perspective, we get brought in sometimes when acquisitions are happening, and there's the banker view that is very much driven by the financials, but we're often asked, what's the operational view behind it? And a typical way that we typically look at this is, how many customers do they have, and what is the customer acquisition cost, and what is the customer acquisition cost as it relates to the acquirer? So at the end of the day, the way that this WhatsApp deal actually makes sense to Facebook is the fact that if I need another 500 million users on Facebook, it's prohibitively expensive for me to acquire them as Facebook versus just buying WhatsApp. And from that perspective, all the things that I used to be serving on my Facebook platform, I can now serve to those same 500 million customers that I brought over. This thing actually looks like a boom for me.
I think it'd be interesting, I welcome your thoughts on looking at a company like Metrotech, for instance, which is not, its customers are a different set of customers. I think Christian would probably say that if he didn't have the opportunity to use the cloud, he wouldn't have been able to get as far as he is today with the amount of money he's had to spend. So there is some benefit if you can leverage the technology, leverage the cloud, be able to get further along with your company than you could have 10 years ago, even without the venture investment. But just curious, to take a company like that, how does the valuation or the metrics for a company like that, does that change what you saw when you were talking about Lutao, or is it similar?
Yeah, I think that we're talking two sides of this. There's the revenue side and the cost side. I think the cost side you can fix, and to I think Rand's point, I think Frank made the point of back in the day in 2000, if you could actually get positive revenue, you're getting tons of investment dollars, and you can fix the cost later. And growth hides a lot of problems, right? But in terms of actually having the cost side under control, because you can actually scale it in the way that they do, that is a great bonus, and it's also something that, from a venture capitalist perspective, they know how to fix it. So if you don't have that in your business plan, and you're not planning to do that right away, the first round that you get, they're going to force you to do it that way. But when I go back to the customer acquisition point, I think it still boils down to, well, how are you going to make money? And I think it's hard to point at how am I going to make money if I don't have an audience? And to the example of, well, if I have an audience of 500 million folks, I'll figure out some way to get them to spend a cent or $1 on everything, and that's a lot of money once I have that audience.
Understand the issue.
The question is generally asking the panel to address net neutrality. There were some slides where we talked about issues that came awfully close to that, even though in a different context.
I'll start, and I'd love to hear the rest of the panel's thoughts on it too. I don't know if any of you have watched John Oliver recently, and I would actually say that he's gotten to the heart of the key issues closer than most of the rest of the media has. Because at the end of the day, the interesting thing is that the telcos don't want net neutrality. It doesn't make any sense from an investment perspective. If Comcast needs 33 to 35% of their internet traffic is off of Netflix, it's a problem. And every night at 7 p.m. to 9 p.m., the entire network is just congested, and it's really because of one player. It's a big problem. And I think on the flip side of it, Netflix doesn't want net neutrality either, even though they come out into the media and say that. Because at the end of the day, they want to be the guy that's first in line, and for the most part, they actually have paid for it in the way that they are paying Akamai for content delivery network infrastructure so that they can actually stream it from a closer distance. I think the problem behind it is, if you think about where the policymakers are going, they're trying to figure out whether or not companies can actually charge a toll for the amount of traffic that's coming through. Now, if you're a startup company, and I'm going to frame it back in that context because a lot of the argument on net neutrality is, you're going to weed out innovation and people aren't going to be able to do and scale the way that they used to be able to in a free internet. But if you look at a startup and where they're going to start from, if they scale from 0 to something, that's going to have a certain network need and a certain network bandwidth need, but it's nowhere near, it's orders of magnitude away from what a Netflix needs. And so by the time they actually need that kind of bandwidth, they're also at a point where they can pay for it. So when you think about it from that context, you wonder, is it really going to stifle it, or is it really a barrier that is hurting some of the more established players and actually not creating a balance that solves this infrastructure problem that we've talked about here?
I think the question is, where will the balance between the services be between advertising and let's see, more merchandising or consumer applications? Is that fair?
Well, I guess I don't have
the answer to that. Yeah,
right. I mean, I think about, we have an investment in Slacker, which is an internet radio company smaller than Pandora. It's interesting to see that people come on and they tolerate the ads, they're fine with the ads, and then over time they convert to paying a subscription. And so I think your analogy is sort of you start free and you move up, or you kind of move on. I don't see merchandising as sort of a long-term play. It's Amazon is just so tough to compete with. So to me, it's sort of a question of, is it free or is it subscription? And I believe that over time, if you deliver quality, you'll be able to charge a subscription.